Hello and welcome back. Corporate America delivered on expectations and then some during a second quarter earnings season that some are calling the biggest upside surprise ever. We recap the results, share 5 key takeaways for investors, and discuss our near-term outlook for stocks with the S&P 500 index near record highs. Much better results than anticipated. Earnings blew away expectations that ended up being way too low. With 92% of the S&P 500 index companies having reported results, the average upside surprise has been 22%, which we believe is the highest recorded going back several decades. At 82% of S&P 500 companies that beat earnings target is the highest since FactSet began tracking that statistic in 2008. Earnings are still tracking to a significant 33% year-over-year decline, but that is certainly better than the 45% decline reflected in analyst estimates when reporting season began. Well, why were the estimates off so much by then? Because of that. We think estimates were off because analysts may have been guessing in many cases because of the lack of guidance from companies, management teams. Other reasons we think played a role include analysts underestimated companies' ability to cut costs. Analysts were surprised by the U.S. economy's ability to bounce back as states reopen. Analysts underestimated the size and impact of fiscal and monetary stimulus. The U.S. dollar weakness provided an unexpected tailwind for multinationals' profits. Companies that provided guidance had every reason to be conservative, given the uncertainty. Results were good enough relative to expectations to prompt us to raise our 2020 S&P 500 earnings per share, EPS, estimated range from $125 to $130 from the $120 to $125 target, as we noted in our August Global Portfolio Strategy publication. Stocks are taking their cues from earnings estimates in 2021 and beyond based on currently elevated valuations, but a potentially higher base in 2020 may improve prospects for 2021 earnings. 5 takeaways. Our top 5 takeaways from second quarter results are these. 1. All of the earnings decline came from 4 sectors. The 4 sectors have been among the hardest hit during the pandemic. That's consumer staples, energy, financials, and industrials. They drove the entire earnings decline for the S&P 500. That means there were 7 S&P 500 sectors that were impressively around flat, collectively, in one of the worst quarters for the U.S. economy in 100 years. Second, the best pandemic performers were mostly on the growth side. The Russell 1000 Growth Index is tracking to a 4% year-over-year increase in earnings for the second quarter. Meanwhile, earnings for the Russell 1000 Value Index are tracking down a whopping 40% year-over-year. The so-called stay-at-home stocks, whose leadership positions have strengthened during the pandemic, are mostly found in the growth indexes, big cap technology, and internet stocks in particular. We continue to believe growth style stocks are well positioned to maintain leadership over value style in the near term, despite signs of life from value stocks recently. 3. Surprisingly upbeat guidance offered. Estimates for future quarters have tended to fall as earnings were being reported in previous seasons. This quarter was a different story, with a 1.4% increase in the next 12 months. S&P 500 earning estimates since the second quarter ended, reflecting upbeat guidance from corporate America. While that may not seem like much, and we still may not see positive earnings growth until 2021, this encouraging development increases the chances that estimates for the third and fourth quarters may prove to be too low as well. Number 4, recent economic data bodes well for the outlook. The upside surprises and increased estimates during the earnings season supported our decision to increase our 2020 estimates for S&P 500 profits. But that's not the whole story. Recent strong economic data relative to expectations may increase the probability of more upside surprises. The Citi Economic Surprise Index, a measure of the frequency with which economic data beats consensus forecasts, is near its all-time high set in July and well above pre-pandemic highs that date back to 2003. Bloomberg's version of that index is near a 20-year high. The July employment report, the latest weekly jobless claims numbers, and the Institute for Supply Management, the ISM, Manufacturing and Services Index, are recent examples of economic reports that came in better than expected. And lastly, number 5, don't forget about the dollar. The nearly 5% drop in the US dollar index so far in the third quarter, which boosts internationally sourced profits for US multinationals, bodes well for the near-term earnings outlook. We have a good problem to have. The S&P 500 has already eclipsed the high end of our 2020 year-end fair value target of 3,300, which raises the question of whether the target should be raised. We're not inclined to make that move right now, although we know that may signal some pessimism for stocks. While 3,300 on the S&P 500 may look pessimistic at this point for a year-end S&P 500 fair value target, we do not want to send a signal to investors to be more aggressive with equities in portfolios at this time for several reasons. We think a pullback may be overdue. The election could drive volatility. The next leg of the economic recovery may get tougher. U.S. and China tensions are ratcheting higher, and stocks may be disappointed if lawmakers cannot agree on another stimulus package. Also, we are valuing the stock market based on earnings 12 to 24 months out, so the strong earnings season this quarter doesn't provide much impetus for us to revalue the S&P 500 higher. If the S&P 500 breaks through to new highs and perhaps we get more good news on COVID-19 therapeutics or vaccines, we may reconsider. But for now, we prefer to keep our target where it is. Looking a year out, we are more optimistic about stocks and more pessimistic about bonds, so we are going to keep our tactical overweight equities recommendation. A COVID vaccine may arrive within that window. What is coming in the future? We will focus on election-related market commentary over the next 2 weeks, beginning August 24th, with a discussion about what the markets and economy may look like in a potential Joe Biden administration. We will follow that up on August 31st with a look at market and economic possibilities during a potential second term for President Donald Trump. Should you have any questions, please feel free to contact your financial advisor here at Proactive Wealth Strategies. Thank you and have a good day.